If you are 5 years from retirement or already drawing Social Security, the rules that governed your parents' benefits are not the rules that govern yours. In the last 15 months, 3 major changes have rewritten parts of the Social Security playbook. A cost of living adjustment of 2.8% kicked in this past January. A new law signed in early 2025 repealed 2 penalties that had cut benefits for nearly 3 million public sector retirees and their spouses. And a tax bill passed last summer created a temporary deduction that, for most middle-income retirees, eliminates the federal tax on Social Security altogether, but only through 2028. By the end of the next half hour, you will know exactly when to claim, how to coordinate a spouse's benefits, what a widow or widower is actually entitled to, how much tax you will owe in 2026, and whether the repeal of the windfall elimination provision has quietly given your household a raise. Welcome back. I am the retirement professor, and this is the retirement classroom. Before we go any further, one quick note. The information in this video is educational. It is not tax or legal guidance, and it is not a recommendation for your specific situation. Social Security rules interact with your pensions, your other retirement accounts, and your state tax treatment in ways that require a professional who knows your full picture. If you would like that kind of review, there is a link in the description for a free 20-minute conversation with our team. No obligation, no sales pitch, just a chance to ask questions about your own numbers. Here is how this masterclass is organized. We will spend the first few minutes on how your benefit is calculated because every other decision downstream depends on understanding that foundation. Then we will walk through claiming strategy for solo filers and for married couples because this is where most of the real money is won or lost. After that, we go deep on spousal, survivor, and divorced spouse benefits. Then we handle taxation, which is the part of Social Security that catches more retirees off guard than any other. And we finish with the windfall elimination provision and government pension offset repeal, plus a step-by-step action plan broken out by how close you are to claiming. One number on the list we are about to cover will probably surprise you. It is the number that decides whether you owe federal tax on your Social Security at all. Stay with me. We will get there in Chapter 5. Let's start with something most Social Security videos skip: how the Social Security Administration actually calculates what you will receive every month. Because if you do not understand this, every claiming strategy we cover later will feel like guesswork. Your benefit is built from 3 numbers. The first is your average indexed monthly earnings. The second is your primary insurance amount. And the third is your claim age. We are going to walk through each of these in plain language so that by the end of this chapter, you can look at your own Social Security statement and actually understand what you are reading. Here's what most people miss. Social Security does not take an average of every year you worked. It takes the highest 35 years of your earnings, adjusts those earnings for inflation using what the agency calls wage indexing, and then averages them. That average divided by 12 is your average indexed monthly earnings, AIME for short. If you worked fewer than 35 years, the agency fills in the missing years with zeros. That is why one of the most powerful moves late in a career is simply working a few more years at a higher salary. You replace zeros or low-earning years in the formula. Now the number the Social Security Administration actually pays you is based on your primary insurance amount, or PIA. Think of PIA as the monthly check you would receive if you claimed the month you hit your full retirement age. Not $1 earlier, not $1 later. The PIA is calculated using what the agency calls a bend point formula. You do not need to memorize this, but understanding the shape of it is essential. Social Security replaces a much higher percentage of the first slice of your average earnings than the next slice, and a much smaller percentage of the top slice. In plain language, the system is progressive. It is designed to replace a bigger share of income for a lower paid worker than for a higher paid worker. That's why the maximum benefit exists in the first place. The formula caps out. So, what is the maximum in 2026? If you have paid into Social Security at the wage base every year for 35 years, and you claim at full retirement age in 2026, your monthly benefit tops out at $4,152. If you delayed until age 70 and claim for the first time in January of 2026, the maximum is $5,181 per month. And if you are 62 this year and claim immediately, the maximum is $2,969 per month. Notice the spread. The gap between claiming at 62 and claiming at 70 is more than $2,200 every month. Over a 20-year retirement, that is roughly $530,000 in lifetime benefits for the exact same earnings record. That is why the claiming decision matters so much. It is not a minor knob. It is the single largest financial lever most retirees will ever pull. Now, most people are not at the maximum. The average retired worker in January 2026 collected $2,071 per month. That is the national average, including COLA. Your own benefit will depend on your earnings history, which you can see by creating a free My Social Security account at ssa.gov. Let's talk about full retirement age, because this is where most of the confusion starts. If you were born in 1960 or later, your full retirement age is 67, period. That is the cohort who is still working today and will be making claiming decisions for the next decade and beyond. If you were born in 1959, your full retirement age is 66 and 10 months. That means you hit it between November of 2025 and October of 2026. So this is the most relevant cohort in the room for anyone watching this video right now. For folks born in 1958, full retirement age is 66 and 8 months. And for those born in 1957, it is 66 and 6 months. The earliest you can claim is 62 for every cohort. The latest you earn credit for delaying is age 70. Waiting past 70 does nothing. You simply leave money on the table. Here's what the reductions actually look like if you were born in 1960 or later and claim early. At 62, you get 70% of your primary insurance amount. That is a 30% permanent haircut. At 63, 75%. At 64, 80%. At 65, just under 87%. At 66, a little over 93%. And at 67, you get the full 100%. Now, this is important. If you delay past full retirement age, Social Security pays you delayed retirement credits worth 8% per year. That rate applies to every cohort born in 1943 or later. So, for the current full retirement age 67 cohort, waiting to 68 gets you 108% of your PIA. Waiting to 69 gets you 116%. And waiting all the way to 70 gets you 124%. That means your age 70 benefit is worth 77% more than your age 62 benefit every single month for the rest of your life. Let me be direct about this. The decision to claim early at full retirement age or late is the biggest controllable dollar decision of your retirement. Chapter 3 is where we actually walk through how to make it. Now we get to the part that pays off the homework. Let's run the numbers. Imagine a single woman named Carol. Her primary insurance amount, the benefit she would get at her full retirement age of 67, is $3,000 per month. If Carol claims at 62, she gets $2,100 per month for life. If she claims at 67, she gets $3,000 per month. If she waits until 70, she gets $3,720 per month. Same earnings record, 3 different outcomes. Here's how to think about the choice. If Carol claims at 62, she starts cashing checks 5 years earlier, 60 payments earlier, to be exact. She gets about $126,000 before her full retirement age rolls around. That is real money. You cannot pretend it is not. But here is the crossover. At roughly age 79, Carol's lifetime total from claiming at 67 catches up to her lifetime total from claiming at 62. From that point forward, every extra month she lives is a month where the age 67 claim is worth $900 more per month than the age 62 claim would have been. If Carol lives to 85, the age 67 decision has paid her an extra $64,000. If she lives to 92, it has paid her an extra $139,000. Past that age, it gets even more lopsided. The crossover between claiming at 67 and claiming at 70 sits around age 82 or 83. So the classic teaching is this. If you expect to live into your 80s or beyond, delaying past your full retirement age is the single highest return, zero risk decision available to most American retirees. There is no bond, no annuity, and no diversified portfolio that can match a guaranteed, inflation-adjusted 8% per year of delay credits paid by the United States government for life. But stay with me here, because there is a reason 80% of retirees do not wait until 70. 3 reasons, really. First, health. If you have a shortened life expectancy and because of a diagnosis or a strong family history of early mortality, the math flips. Someone who reasonably expects to live to 75 should claim earlier. Social Security is an annuity on your life. If the life is shorter, the annuity is worth less. Second, cash flow. If you need the money at 62 because you were forced out of your job, or because health issues took you out of the workforce, or simply because waiting is not financially possible, claim it. A smaller guaranteed check is infinitely better than drawing down your portfolio at a rate that risks running out. Third, portfolio efficiency. If you have substantial IRA and 401k assets, claiming earlier may allow you to preserve those assets, which can continue growing tax-deferred, while Social Security covers your baseline expenses. The interaction is more complicated than people think, and it is one of the most common reasons people book a review with an advisor. Now let's talk about couples, because for a married couple, the claiming decision is not a single decision. It is two coordinated decisions. Here is the classic coordination rule, and it still holds under current law. The higher earning spouse delays. The lower earning spouse has more flexibility to claim earlier. Here's why. When one spouse dies, the survivor steps up to the higher of the two benefits. That means the higher earner's benefit, including any delayed retirement credits, becomes the survivor benefit for whichever spouse lives longer. By delaying the higher earner's benefit to 70, you are not just maximizing their check. You are maximizing the check that will pay the survivor for potentially decades after the first death. Think of it this way. The higher earner delaying is, in effect, buying a life insurance policy for the surviving spouse, with a guaranteed inflation-adjusted payout at a price most people never even think about. The lower earner does not face the same survivor benefit arithmetic, because a lower earner's benefit will typically be replaced by the higher earner's benefit when the higher earner dies, so the lower earner often has more room to claim earlier, cover current cash flow, and preserve portfolio assets. Now, this does not always apply. If both spouses earn similar amounts, the calculation changes. If one spouse has a health concern, the calculation changes. This is where a retirement income review genuinely earns its keep. A specialist can run both claim ages for both spouses and show you the expected lifetime present value number under each combination. So we have covered solo claiming, the 3 reasons people choose earlier dates, and the higher earner delays rule for couples. Before we move on, let me pause on a question I get all the time. I'm 64 and still working. If I claim Social Security now, will they take my check? This is the earnings test, and it is the most misunderstood rule in the system. In 2026, if you are under full retirement age for the whole year and still working, Social Security deducts $1 of benefits for every $2 you earn above $24,480. So if you earn $40,000, you are $15,520 over the limit. Social Security withholds $7,760 in benefits, about half. In the year you reach full retirement age, but before the month you actually hit it, the limit jumps to $65,160, and the withhold is $1 for every $3 over. And from the month you reach full retirement age onward, there is no limit at all. Earn whatever you want. Here is what almost nobody knows. The benefits that are withheld are not lost. At full retirement age, Social Security recalculates your benefit and pays those withheld amounts back to you as a permanent increase in your monthly check. The agency calls this the adjustment of the reduction factor. It's essentially deferred income with a built-in safety net. You don't lose the money, you lose the cash flow in the year you were over the limit. One more point on claiming strategy before we move to spouses and survivors. If you filed for Social Security and regret it, you have 2 recovery paths. If it has been less than 12 months since you started benefits, you can withdraw your application entirely. You pay back the benefits you received, and it is as if you never claimed. You can file again later. This is a one-time rule. You can only do it once in your lifetime. If more than 12 months have passed, but you have reached full retirement age, you can suspend your benefit. Your check stops, and you begin earning delayed retirement credits, that same 8% per year, until you restart at a higher rate. These are powerful but narrow tools. Know they exist. This is the chapter where more real money gets left on the table than anywhere else in Social Security, because most retirees understand their own retirement benefit, but they have never been walked through how their spouse's benefit or their late spouse's benefit actually works. Let's take spousal benefits first. A spousal benefit is a payment based on your spouse's earnings record, not your own. The maximum spousal benefit, if the claiming spouse waits until their full retirement age, is 50% of the higher earner's primary insurance amount, not 50% of what the higher earner actually collects, 50% of their PIA. Here's what most people miss. If the lower earning spouse has their own PIA, Social Security does not stack the 2 benefits. Instead, you get the higher of the 2, either your own retirement benefit or the spousal benefit. If the spousal benefit is larger, Social Security pays you your own benefit, plus a spousal top-up that brings you up to the 50% target. You never get both in full. Let me walk you through a concrete example. Imagine a couple named Jim and Sarah. Jim's PIA is $3,000 per month. Sarah's PIA is $1,200 per month. The maximum spousal benefit Sarah can claim is 50% of Jim's PIA, $1,500. Since Sarah's own PIA of $1,200 is less than that, she is eligible for a spousal top-up of $300. If she claims at her full retirement age, her total monthly benefit is $1,500. Her own $1,200 plus the $300 top-up. If Sarah claims before full retirement age, that top-up gets reduced. And here's a key fact that catches people off guard. A spousal benefit does not earn delayed retirement credits. There is no reason for Sarah to delay past her own full retirement age if she is only collecting a spousal benefit. Delay credits apply to your own retirement benefit only. One more wrinkle on spousal benefits. For anyone born in 1954 or later, which is basically everyone still making claiming decisions today, the deemed filing rule applies. When you file for your own retirement benefit, Social Security automatically files you for any spousal benefit you are entitled to. And when you file for a spousal benefit, Social Security automatically files you for your own retirement benefit. You cannot pick and choose. The old strategies known as file and suspend and restricted application, which let a spouse collect one benefit while delaying the other, were eliminated by the Bipartisan Budget Act of 2015 for everyone born on or after the cutoff date. This is why there is no such thing as a clever Social Security hack for most couples today. The clever moves were legislated away. What remains is straightforward optimization, higher earner delays, lower earner chooses based on cash flow and health. Now, survivor benefits. When a spouse dies, the surviving spouse is entitled to a survivor benefit. This is completely separate from the spousal benefit we just covered. The maximum survivor benefit is 100% of the deceased spouse's benefit, including any delayed retirement credits they had earned by waiting. This is the single biggest reason the higher earning spouse delays rule matters. If Jim, in our example, had delayed his claim until age 70 and was receiving $3,720 a month when he passed, Sarah would be entitled to a survivor benefit of $3,720 per month for the rest of her life. If Jim had claimed at 62 and was receiving $2,100 a month when he passed, Sarah's survivor benefit would be capped at $2,100. That single decision, when to claim, reached across decades to set the income of the surviving spouse. This is the math that moves 6 figures of lifetime retirement income. And most couples make the decision without understanding it. A few critical details about survivor benefits. You can claim a survivor benefit as early as age 60, or 50 if you are disabled. Although if you claim before your survivor full retirement age, the benefit is reduced. At age 60, you would receive about 71.5% of the full survivor amount. For a widow or widower born in 1962 or later, the full survivor retirement age is 67, matching the regular retirement full retirement age. Now, here is the single most important strategy point in this entire masterclass. Deemed filing does not apply to survivor benefits. A widow or widower can file for survivor benefits first and switch to their own retirement benefit later, or file for their own first and switch to survivor later. This is the one sequenced filing strategy the 2015 law left intact, and it can be enormously valuable. Here's when it matters. Imagine a 62-year-old widow whose late husband was collecting $3,000 per month. Her own benefit at full retirement age would be $2,500, and if she delayed to 70, it would be $3,100. She can claim a reduced survivor benefit now, around $2,100 per month, and let her own retirement benefit grow with delay credits. At 70, she switches to her own benefit of $3,100 per month, and she has collected 8 years of survivor benefits in between. This kind of sequencing has paid some widows an extra $150,000 or more over a 25-year retirement. The rule for anyone widowed at any age: do not file for anything without modeling both sequences. This is one of the highest value conversations a retirement planner can have with a client. Finally, divorced spouse benefits. If you were married for at least 10 years, you are currently unmarried, you are at least 62, and your ex-spouse is at least 62, you can claim a divorced spouse benefit on your ex's record. The math works the same as a spousal benefit, up to 50% of the ex's PIA at your full retirement age. Your ex does not need to have filed yet for you to claim. Your claim does not affect your ex in any way. Your ex is not notified. And if your ex has passed away, a divorce survivor benefit works like a regular survivor benefit, up to 100% of the ex's benefit amount, as long as the 10-year marriage requirement is met and you are currently unmarried or remarried after age 60. Millions of Americans who went through a divorce in their 40s or 50s have no idea they are eligible for benefits on an ex-spouse's record. If this might apply to you or to someone you love, check it. Social Security does not tell you that you are eligible. You have to ask. Here's where we get to the number I promised you in Chapter 1, the one that decides whether you owe federal tax on your Social Security. Almost every retiree thinks Social Security is taxed based on their total income. It is not. It is taxed based on a specific calculation that Social Security calls combined income, what the IRS sometimes calls provisional income. Here is the formula. Your combined income equals your adjusted gross income plus any tax-exempt interest you received during the year, plus 1/2 of your annual Social Security benefits. If your combined income as a single filer is below $25,000, none of your Social Security is taxable. Zero. Between $25,000 and $34,000, up to 50% of your benefits become taxable income. And above $34,000, up to 85% of your benefits become taxable. For married couples filing jointly, the thresholds are $32,000 and $44,000. Below $32,000, none is taxable. Between $32,000 and $44,000, up to 50%. Above $44,000, up to 85%. Now read those thresholds back to yourself. $25,000, $32,000, $44,000. Here's the number most retirees have never heard. Those thresholds were set by Congress in 1983. They have never once been adjusted for inflation, never. In 1983, the $25,000 threshold was higher than the median household income in America. In 2026, it is well below the amount most retirees draw just from Social Security plus a modest individual retirement account withdrawal. That is why every year more retirees find themselves paying tax on benefits that would not have been taxed if the same rule had kept pace with inflation. And let me be direct about something else. 85% taxable does not mean an 85% tax rate. It means up to 85% of your Social Security benefit gets added to your ordinary taxable income and then taxed at your regular marginal rate, which for most middle-income retirees is 12% or 22%. If you are in the 12% bracket and 85% of your benefit is taxable, you are paying roughly 10% of your Social Security in federal tax. It is real, but it is not ruinous, and it is not what most people picture when they hear 85%. Now, here is the big 2026 change. Last summer, Congress passed and the President signed the One Big Beautiful Bill Act. Among many provisions, that law created a new temporary senior bonus deduction for taxpayers age 65 and older. If you qualify, you can deduct an extra $6,000 per person from your taxable income. For a married couple where both spouses are 65 or older, that's $12,000 in additional deduction, on top of the regular standard deduction, and on top of the existing age 65 additional standard deduction that has been in the tax code for years. This deduction phases out at higher incomes. For single filers, the phase-out begins when your adjusted gross income tops $75,000 and is fully gone by $175,000. For married couples filing jointly, the phase-out starts at $150,000 and finishes at $250,000. Here's what that means in practice for middle-income retirees. The Tax Foundation estimates that about 90% of retirees will owe zero federal income tax on their Social Security under this rule, up from roughly 60% before the law changed. For millions of households, this effectively does what politicians talked about for decades, but never delivered. It eliminates the federal tax on benefits, not by repealing the underlying Social Security tax formula, but by creating a deduction big enough to zero out the tax. Now, there is a catch, and it is an important one. This senior deduction expires on December 31st, 2028. Unless Congress votes to extend it, which is never guaranteed, 2029 returns to the pre-bill treatment. That means retirees need to plan with both realities in mind. Enjoy the deduction while it is in effect, but do not bake a permanent zero tax assumption into a 30-year retirement plan. Let me put this together with a real couple. Meet Mike and Linda. Both are 67. Mike collects $30,000 per year in Social Security. Linda collects $24,000 per year. Together, they take $30,000 out of Mike's individual retirement account to cover the rest of their lifestyle. No pension, no tax-exempt interest, no other income. Combined income equals their $30,000 IRA withdrawal plus half of their $54,000 Social Security. That's $27,000 for a total combined income of $57,000. That is above the $44,000 threshold, which means up to 85% of their Social Security is taxable. Running the IRS worksheet gives them about $44,000 of taxable benefits added to their taxable income. Before the One Big Beautiful Bill,
Mike and Linda's tax situation would look roughly like this. $44,000 of taxable Social Security plus $30,000 of IRA, minus the standard deduction for a married couple over 65, about $33,000 in 2026, gives them around $41,000 of taxable income. At roughly 10% average federal rate after the 10% and 12% brackets, that is about $4,000 in federal tax owed. Under the new law, they add $12,000 of senior deduction because both are 65 or older, and their AGI is under the $150,000 threshold. $12,000 comes right off that $41,000 of taxable income, bringing them down to around $29,000 of taxable income. That drops their federal tax bill to about $2,700, a savings of roughly $1,300. And for couples with less additional income, the senior deduction can zero out the federal tax entirely. One last point on taxation. State income tax treatment of Social Security varies. As of 2026, the overwhelming majority of states, 41 of them, plus the District of Columbia, do not tax Social Security benefits at all. A small number of states still tax some or all benefits, though several have been phasing that treatment out in recent legislative sessions. If you live in or are considering a move to one of the remaining states that taxes benefits, this should be part of your retirement location analysis. We have a separate video on the best and worst states for retirees that goes deeper on this. Link in the description. We've covered how benefits are calculated, when to claim, spousal and survivor rules, and taxation. Now let's talk about a historic change that took effect on January 5th, 2025. A change that restored full Social Security benefits to more than 3 million Americans who had been shortchanged for decades. I'm talking about the Social Security Fairness Act. That law repealed two provisions that had quietly reduced, and in many cases wiped out, Social Security benefits for public servants, teachers, firefighters, police officers, postal workers, and many state and local government employees. Those provisions were called the Windfall Elimination Provision, known as WEP, and the Government Pension Offset, known as GPO. Here's what those rules used to do. If you spent part of your career in a job that did not pay into Social Security, for example, many state teacher pension systems, some police and fire systems, and certain federal civil service jobs under the old CSRS system, and you also earned Social Security benefits from other work, the WEP formula would slash your own retirement benefit, not trim it. Slash it. Reductions of $400, $500, $600 a month were routine. The GPO hit even harder for spouses and widows. 2/3 of your non-covered pension was subtracted from any spousal or survivor benefit. For many retired teachers and public safety spouses, the GPO zeroed their Social Security survivor benefit to the penny. Here's what most people miss about the repeal. The repeal was retroactive to January of 2024. That means affected retirees were owed more than a year of back benefits. By early 2026, the Social Security Administration had already paid out over $17 billion in retroactive payments to more than 3.1 million people, with average retroactive checks in the $6,000 range. If you were affected by WEP or GPO, you would already have received a lump sum retroactive payment, plus an increased ongoing monthly benefit. If you or a spouse worked in a WEP or GPO job, teacher in Texas, California, Ohio, Illinois, Colorado, or one of the other non-covered states, police or fire in a non-covered system, pre-1984 federal CSRS service, and you have not seen a benefit increase or a back pay deposit, call Social Security at 1-800-772-1213. Do not assume it was automatic in every case. Complex situations, particularly survivors and divorced spouses, sometimes required a manual review. If you were previously told not to even bother filing for a spousal or survivor benefit because GPO would zero it out, that guidance is now obsolete. File an application. Many spouses and widows who never expected to see a Social Security check are now receiving meaningful monthly benefits. Now let's bring everything together. We've covered a lot in this masterclass. 3 historic changes, the 2.8% COLA, the WEP and GPO repeal, and the temporary senior bonus deduction. We've walked through benefit formulas, claiming ages, spousal coordination, survivor planning, and taxation. Let me give you 4 concrete action plans depending on where you are in your journey. Your highest impact move right now is maximizing your top 35 earning years. Social Security uses your best 35, indexed for wage growth. If you have gap years, years you earned little or nothing, each additional high earning year you add between now and claiming will replace a lower year and lift your primary insurance amount. If you're self-employed and have been underreporting to minimize payroll tax, understand the trade-off. Every dollar you don't run through Social Security is a dollar that never counts toward your benefit formula. Second, check your earnings record. Log into My Social Security at ssa.gov and verify every year of wages. Employer reporting errors happen. Missing years are harder to fix decades later. Third, run a rough estimate of your future benefit now, not to lock in a plan, but to see the magnitude. If your projected benefit at age 70 is $3,500 a month, that is $42,000 a year, inflation adjusted for life, that is a meaningful pillar of your retirement plan and should inform how aggressively you save elsewhere. You are in the decision zone. Between now and claiming, 3 things matter most. 1, get an individual benefit estimate from SSA.gov, not the ballpark figure on the annual statement, but a detailed estimate that lets you compare age 62, full retirement age, and age 70 side by side. If your situation includes a spouse, run the spousal and survivor numbers too. 2, map the crossover. Remember Carol from Chapter 3? Filing at 70 rather than 62 costs her 8 years of checks but starts paying back by around age 79 and pays substantially more for every year she lives past 82. Your crossover point depends on your numbers, but the structure is the same. Match that crossover against your family longevity and your other income sources. 3, model the tax picture. If you are going to have IRA withdrawals, pension income, part-time work, and Social Security and retirement, the combined income formula from Chapter 5 will determine how much of your benefit is taxed. Sometimes delaying Social Security and drawing down tax-deferred accounts first, filling up lower tax brackets in your 60s, produces a lower lifetime tax bill, even though it feels counterintuitive. That is a strategy worth modeling carefully. Before you file, run 3 checks. Check 1, your earnings record. Log into My Social Security, pull your earnings statement, and verify every year. If a high-earning year is missing or understated, fix it with the Social Security Administration before you file. Once benefits start, correcting old records is harder. Check 2, your household strategy. If you are married, the higher earner delaying to 70 is usually the strongest single move a couple can make because that benefit becomes the survivor benefit for whoever lives longer. If you are the higher earner and your spouse already claimed, do not casually file at 63 because the money is there. Understand what each year of delay buys for survivor protection. Check 3, the earnings test. If you are under your full retirement age and still working, the earnings test will withhold some or all of your benefit above the 2026 thresholds. $24,480 in the years before FRA, $65,160 in the year you reach FRA. The money is not lost, it is added back at FRA through a benefit recomputation. But if cash flow matters this year, claiming while still working full-time may not give you the check you expected. 3 things to audit. 1, your 2026 cost of living adjustment. Your January check should reflect the 2.8% COLA, net of the new Medicare Part B premium of $206.50 a month. If you have not checked your benefit verification letter on SSA.gov since December, pull it now and make sure the numbers match. 2, your Medicare and IRMA status. If your income has dropped since the tax year Social Security used to calculate IRMA surcharges, often a 2-year look-back, you may be able to file a life-changing event appeal using Form SSA-44. This is one of the most commonly missed money-saving moves for retired middle-income households. 3, your taxation. Given the new senior bonus deduction, revisit your withholding. Form W-4V lets you set federal withholding on Social Security at 0, 7, 10, 12, or 22%. If you were previously over-withheld in anticipation of higher taxable benefits, you may be able to reduce withholding and keep more of each monthly check. And if you or a spouse was affected by WEP or GPO and have not yet seen the Social Security Fairness Act increase reflected in your benefit, call Social Security directly. Do not wait. Before we close, one broader point. Social Security was never designed to be a sole source of retirement income. The average retired worker benefit in 2026 is about $2,071 per month, roughly $24,800 a year. For most middle-income households, that replaces somewhere between 30 and 40% of pre-retirement earnings. It is a foundation, not a full structure. What you are doing right now, taking the time to understand the rules in detail, is exactly what separates retirees who build that structure deliberately from retirees who take whatever filing age the first conversation suggested and then wonder 15 years later whether they left money on the table. The rules reward careful planning. Between the formulas, the coordination between spouses, the taxation mechanics, and the new senior deduction, there are several $1,000s of annual income. In many cases, tens of thousands of dollars over retirement, sitting inside decisions most people make in an afternoon without running the numbers. This masterclass gave you the framework. The math is yours to run against your specific situation. If you'd like a second set of eyes on your claiming decision, your household strategy, or your tax picture, I offer a free 20-minute retirement consultation.
We will look at your actual numbers, your earnings record, your spousal or survivor situation, your combined income, the state you live in, and map out the claiming age and withdrawal sequencing that makes the most sense for your plan. No obligation, no sales pitch, just a candid conversation. The link to book is in the description, and I'll put it on screen right now. If you got value from this masterclass, subscribe to the Retirement Classroom. Every Thursday I publish a new masterclass. Next week we are digging into the withdrawal order, which accounts to tap first, and why the conventional taxable, then tax-deferred, then Roth rule often leaves money on the table for middle-income retirees. Every Monday, Tuesday, and Wednesday, we publish shorter 8 to 12-minute deep dives on specific retirement questions. And every Saturday, we publish a Friday Reacts video where I walk through that week's retirement news. Thank you for spending this time with me. The work you are doing to understand these rules is the work that builds a confident retirement. I'll see you in the next video.
Hey, before you go, if you're serious about your retirement, we'd love to help. Scan the QR code on screen right now or visit the link in the description to book a completely free strategy session with a qualified professional. It only takes a couple minutes to fill out, and there's absolutely no obligation. Take the first step today. We'll see you in the next one.